What's up, everyone? Welcome to another episode of The Remote Real Estate Investor. I'm Michael Album, and today I'm joined by Avery Carl, distinguished author, speaker, investor, agent, mortgage broker. She does it all, and she's going to be talking to us today about things you need to be aware of when looking for short-term rentals. So let's get right into it. Avery Carl, thank you so much for taking the time to hang out with me today. I really appreciate you coming on.
Thank you so much for having me.
No, my pleasure. So I think a lot of our listeners probably already know who you are. You've got quite a bit of notoriety behind you. But for anyone who's not familiar, can you give us a 30-second elevator speech on who you are, where you come from, and what it is you're doing in real estate?
Yes. So my name is Avery Carl. I am the author of Short-Term Rental, Long-Term Wealth, a book about investing in short-term rental properties. I'm a real estate investor. I own 100 doors, but 8 of them are short-term rentals, and I was able to scale from 0 to 100 doors over the course of about 5 years with a starting salary of $37,000 a year because I invested mostly in short terms at the beginning of my portfolio. So since those cash flows so much heavier than long terms, I was able to scale much more quickly than if I'd started with traditional long terms. I also own the Short Term Shop, which is a real estate agency that focuses exclusively on working with short-term rental investors, where not only do we act as the real estate agents to help them purchase their property, we also teach them everything they need to know about managing their property remotely. We help them get it all set up on the listing sites and teach them the ropes of remote self-management. We've helped about 4,500 families build some generational wealth through real estate investing there. And then I also co-own the Mortgage Shop, which is basically the mortgage counterpart of the short-term shop. We focus mostly on short-term rental investors there as well.
Oh, that's awesome. So you were doing short-term rentals before it was cool, it sounds like.
Yeah, just slightly before.
That's awesome. And so what is it you think that people need to know if they're just getting started in the short-term rental business?
So I think the main thing to know is that you don't have to live in the city or even drivable to the city where you're investing. You can't always live in the best place to invest. So getting comfortable with long distance real estate investing can make sure that you are able to make the most lucrative investment in short-term rentals.
That makes total sense. And what a place to have you on the Remote Real Estate Investor. It's perfect. So how do you evaluate what a short-term rental market looks like? Because doing the long-term thing, I think, is relatively easy. I can go on Zillow, I can go on property manager websites and see, okay, what is the rent, the monthly rent versus what are my expenses, ballpark, and what is the price? So what is it that you're looking for in a short-term rental?
I'll start by saying there's not necessarily a black and white, right or wrong way to do it. There's a certain way that I do it. But there are 3 types of markets that you can invest in short-term rentals. The first one is the metro market. So like Nashville, Austin, New York, places like that. The second is the big I call it fly to vacation rental market. So these are the markets that people are like saving up all year to take a big vacation to, like flying to Aspen, flying to Hawaii, places like that.
Okay.
And then the third type, which the type that I focus on exclusively with myself and my clients, is the regional drivable vacation rental market. So these are areas that the majority of people that travel to them are traveling between 5 and 8 hours by car, like the Smoky Mountains in Tennessee, Panama City Beach, Florida, Big Bear in California, places like that where people aren't necessarily taking these big expensive vacations. They're really affordable and they're really accessible. So that's the type of market that I focus on.
That makes sense. And I actually just bought my first vacation rental out in the Smokies, and I'm very excited to hear all the big news about it.
Awesome.
Yeah. So curious to know, when I think one of the biggest hurdles or biggest risks that people see with short-term rentals is changing jurisdictions or jurisdictions changing their laws or ordinances. And so what's something that people can do to combat that or to be ahead of that curve when looking at short-term rental markets?
So choosing the market is really going to be your the biggest thing to get through in terms of getting past that. So I used to have an office in Nashville where we sold short-term rentals. I shut it down because Nashville is really, really volatile in terms of short-term rental regulations. So that's why I focus on the regional drivable vacation rental markets, because they're typically areas like, take the Smokies, for example. People have been coming to the Smokies since the 60s and 70s and staying in cabins rather than hotels. Also, Destin, Florida, where I live right now. I'm actually reading a really nerdy book about the history of this area right now.
Awesome.
And there were actually vacation rentals that people rented here in the 20s before they actually even had electricity out here.
Oh my gosh.
These are areas, I focus on areas that short-term rentals are not a new thing as of the inception of Airbnb. Focus on areas that people have been staying in condos, beach houses, cabins in the mountains since well before Airbnb existed. So you run into the problems with the changing of jurisdictions and things like that. It mostly in metro markets. It does happen in vacation markets as well, but it's mostly metro markets or areas where people have historically stayed in hotels, like Nashville, for example. There were not short-term rentals. There were not vacation rentals until Airbnb came along. Everybody who came to Nashville up until mid-2000s stayed in hotels. There's also a lot of primary residence because there's a lot of industry outside of tourism in Nashville. So there's a lot of jobs. So there's a lot of primary residence. So when Airbnb came along and investors started realizing how much money they could make in metro markets, obviously a lot of investors moved in, started taking market share away from the hotels, started making primary homeowners angry because they're moving into what was previously a quiet neighborhood where people are trying to raise their kids, opening up Airbnbs. Yeah. Nashville is like, the bachelorette party capital of the world. You can see why you might not want that happening next door to where you're trying to raise your kids. So it's the hotel presence and primary owners, primary residents that kind of come together to make anti-short-term rental regulations happen. So we stick to those markets where the cities and counties figured this out a long time ago, figured out how to monetize it a long time ago. This is the way that it's always been. And the cities and counties are just way too dependent on the income from short-term rentals financially to ever really regulate against them.
That makes so much sense. I love it. So something that I like, a personal take that I've had on short-term rentals is I've always said, well, I'll invest in a short-term rental if it also makes sense as a long-term rental because I'm scared of the ordinance or law changing. But it sounds like for you, because you've really done your homework, that's not a concern that you have. Is that fair to say?
Yeah. So, and that's kind of, a pro and a con of vacation markets versus metro markets. Is metro markets you could convert to a long-term, probably, if the numbers make sense. But in the Smokies or in Destin or any of our other markets that we operate in, there are more short-term rentals and there are people who actually live in those areas because it's so heavily dependent on tourism that if something came along and wiped out all of the short-term rentals, you probably would not be able to convert to a long-term just because there's not enough people to need that. But again, these areas have been through decades and decades of economic ups and downs. So there's still tourists coming and they're coming heavy. So, we feel pretty confident about it. And then if there was anything that was going to come along and sweep away all the short-term rentals, it would have been a global pandemic. And it actually had the opposite effect. So I think we're pretty good. We're feeling pretty good about it.
Awesome. And you took the words right out of my mouth. I was going to ask, how was it for you? Because you've been involved in this over 5 years. So through the pandemic, what did you see in your short-term rentals during that time?
Sure. So short-term rentals still, as of 2020, being a little bit of a new asset class. When COVID came along, and we had, at the time, I think we had 5 short-term rentals and maybe 20 or 30 long-terms. When COVID happened, we thought, oh, crap. There go the short terms. The apartment building investors were right. This is an early adopter crap. Right. Great. Well, at least we have our long terms because if this kills the short terms, we at least have a long term. Well, actually, it was the opposite. So, we sat on the couch and watched Tiger King for 2 weeks and opened back up, and then the doors got blown off. We were getting higher prices per night than we've ever seen. We still are. All of our income has increased in all the markets we invest in across the board. But actually the opposite of what we thought was going to happen happened. So we didn't have to worry about the short terms. They're doing great, better than they ever have. But we had to worry about our long terms because of the eviction moratorium. So luckily we only had one eviction and that person was a problem well before COVID. So we actually our entire portfolio came out just fine. Really no change on the long-term front, but the short terms just skyrocketed.
I'm glad to hear it. I had a similar experience with the long terms and I was so thankful for it. So knock on wood that it continues. Yeah. So Avery, I'm curious, and let me know if it's market dependent and we can talk kind of market specifics, but I'm curious to know what type of property condo, townhome, apartment, single family, cabin, do you target for your short-term rentals?
I personally do only single families. Condos work really well in beach markets. Nothing wrong with condos. I just prefer single families. Condos don't work so well in mountain markets. Typically, the tourists in mountain markets are more interested in staying in cabins. I know a lot of people are kind of trying to get into the multifamily short-term rental thing. To me, that's a hotel, guys. It's already been done. Like, they're like, oh, I have this great idea. We're going to do multifamily short-term rentals. Nobody's ever done this before.
I'm a genius. Yeah.
Yeah. So we stick to single families. We have multis in our long-term portfolio, but we stick to single families mostly.
Okay, awesome. And so here's like a massive dichotomy between the long-term and the short-term market. In the long term, there's a price point for single family at which that's not going to cash flow because your rent's just not going to keep up. Versus your short-term, does that occur? I mean, is there a spread at which, I'm just paying too much money for the purchase that the rental income is not going to support it? Or does that not exist?
Yeah, sure. There's definitely a limit. But the thing about short terms is they're more difficult to analyze because it's always a range of what a property will be able to do. Whereas in long term, it's like, this is the rent. This is going to be the rent all year. And unless you go in and gut the property and do all this updates, that's what it's going to be. Whereas short terms, it's always kind of a range because, a week in the second week of February, you're going to be making way less money than the second week of July. So it just kind of depends. And then also, there's a range of the income it can make really just based on how you manage the property. So, I mean, for example, even if two people own the exact same property right next door to each other, long-term rentals, they're making the same no matter what. Short-term, even if they manage everything exactly the same, but one person has a 2-night minimum night stay and the other person has a 5-night minimum night stay, the 2-night minimum night stay person is going to make more money because they have less holes in their calendar that are 1, 2, 3, and 4 days long. So even just little tweaks like that can make a difference. Although there does come a point that like a 2-bedroom, the most a 2-bedroom is ever going to make is here. And if the purchase price is here, then it doesn't make sense. So you just have to get a lot of different data points for your analysis.
Yeah, makes total sense. And so to that end, how do you recommend folks evaluate the properties or potential income from an expense perspective? Because that's something I've seen is massively different than your long-term as well. So what do you recommend to folks?
So I recommend there are several different places you can get data for the short-term rental performance. AirDNA is one of them. It's not perfect. It's decent, good enough. Rabu is another one. RABBU has some pretty good data. Price Labs, which is actually a pricing manager that you would buy when you buy a short-term rental. You get a subscription to this to help you price your property. It has a function called the market dashboards, which will give you a pretty good data on properties in that market. So I recommend getting data from 2 or 3 different sources. And then as far as expenses and things like that, so in conjunction with looking at the numerical data, at the short-term shop, we preach something called the enemy method, which is where you go in on Airbnb and VRBO, zoom in on the neighborhood that you're interested in buying in, and look at your enemies or your neighbors. Enemies just kind of tongue in cheek, but look at them. There's a few things you're looking for when you do the enemy method. So there are things that the numbers and the data can't tell you, like the intangible reasons that the properties are performing the way that they are. So you're going in, you're looking for outliers, like, if you've got a 4-bedroom that you're looking at and next door is like a 4-bedroom dump with terrible pictures and the host never responds. So it's like way, way, way down in the search results and never gets seen. Well, that's going to drag the data down. You're going to be able to do better than that one, obviously. Or conversely, if next door is another 4-bedroom that is just like the craziest 4-bedroom anybody's ever seen, and it's like celebrities rolling in and out in there, and you're like they're charging $1 million a night to get to meet these celebrities at your house. Well, that's going to drag the data the other direction. So you're looking for that. You're also looking for what your enemies' cleaning fees are, because that's going to be a big one for you. And then the rest of it is very similar to as if you were purchasing the house for a primary home, like in terms of internet costs, utility costs, things like that. I found that my maintenance costs in short term are less than in my long-term rentals. They're more like 1% of my income.
Hmm.
Just because you have a cleaner in there who's professionally cleaning 2, sometimes 3 times a week. So nothing ever really falls into that much disrepair if your cleaner is doing their job and, letting you know stuff's happening. Whereas my long terms, they're doing God knows what in there all year, maybe 2 years, maybe 3 years, however long they stay. And when they move out,
that's when you find out about it.
Yeah. Paint, carpet, cabinets, the whole thing.
Yeah. Okay. That makes a ton of sense. I want to shift gears a little bit here and talk about a topic that's very near and dear to my heart, which is insurance. And so how do you insure these things? Because it's this kind of unique thing that I feel like a lot of insurance companies really haven't wrapped their heads around yet.
Yeah. So you definitely want to get short-term rental specific insurance. Proper is the biggest name in that space. They are also the most expensive, but they do have pretty comprehensive coverage, like all the way down to covering lost income if you get bed bugs. Some insurance companies are kind of catching on and adding short-term rental riders that you can add on. You also want to, or I recommend anyway, getting a commercial umbrella policy in addition to short-term rental specific, just to make sure that you're totally covered. And I get this question a lot because Airbnb and VRBO do offer $1 million worth of liability coverage when you sign up with them. And a lot of people are like, do I need insurance in addition to that? Yes, 100,000%. Do not rely only on what Airbnb and VRBO provide, because their goal is to not have to pay that. So better to be overinsured than under. So definitely make sure that you're getting STR specific and a commercial umbrella.
Okay. And so kind of in that vein, if someone's owning these short-term rentals in their personal name, do you think a commercial umbrella is still appropriate, or could they just add it on to their maybe existing personal umbrella?
You could. It just kind of depends on your entire financial picture and really just kind of a number of things. So it's hard to answer, but I would recommend just everything you can get it. It's better to have it and not need it than need it and not have it.
No, I'm right there with you. And it's one of those things like you're only going to know how much you really needed after a loss or after a claim. And by then it's a little bit too late. So I'm with you 100%. All right. And then so shifting gears here again, how do you purchase these things? And it's so perfect that you own the mortgage shop. And so because there are short-term lenders out there, but I feel like they're kind of few and far between. And if you start talking with your traditional lenders about, I'm doing short-term rentals, like, I don't know. So what are some things that people should be looking for? And what are some products that the mortgage shop offers that people might be able to take advantage of?
So we have 3 main products that most people use. A lot of people use that 10% down vacation home loan. That's a conventional product. There are rules that you want to make sure that you are following in regards to doing that, meaning you do have to use the property for, I think it's about 2 weeks a year. There's nothing out there prohibiting you from renting it on Airbnb and VRBO the rest of the year when you're not using it. But what you don't want to be doing is skirting the rules and trying to syndicate with a bunch of people using 10% downs and taking equity there and all that. Don't skirt the rules because you're going to get the product taken away from all of us.
Don't ruin it for the rest of us.
Fannie has caught on to people abusing that. For buying, I saw somebody in a Facebook group the other day that was like, yeah, that second home loan's awesome. I've got 2 on the same street as me that are both second homes. And there's no, they totally lied. They had to have lied to their loan officer to even get that, because one of the main things is it has to be, there's not a specific mileage amount that it has to be away from your primary, but a lot of lenders use 50 miles or 65 miles because it has to make sense. You're clearly not vacationing in a home on the same street as you. So that's the kind of thing that will get it taken away from everyone. But if you want to buy a vacation home that you're going to use for 2 weeks out of the year and rent it the rest of the year, you can totally do that for 10% down. So a lot of people do that. We also have a 15% down investment loan that is also conventional. So if you just want to use this as a pure investment, 15% down, you don't have to worry about all the second home rules. You can just do it. That goes up to the jumbo limit, which I think is a $725-ish or $750 purchase price. I'll have to look. And then the biggest one that people have been using lately is what's called a Dscr loan. So that's a debt service coverage ratio loan. It's kind of a mix between a portfolio and a commercial loan. So it's not conventional. So the interest rate is going to be a little bit higher. It is 20% down, but you can close it right in your LLC. It doesn't take into account any of your income or debt to income ratio. all that it counts on to qualify is, will the property make the same amount as what the mortgage payment will be on a 1-to-1 ratio? So if the mortgage payment is $2,000 a month, all we need to see is that the property will make $2,000 a month in income, and you qualify. So that's a really, really great one, especially for people who maybe have switched from W-2 income to 1099 income and they don't have 2 years to show yet, or maybe you're out of conventional loans because you can only have 10, or maybe you have the down payment, but your debt to income's a little wonky. So a lot of people are using that Dscr loan just because you can drop it right in your LLC. You can have unlimited finance properties, and it's just a lot easier to deal with and not having to qualify based on your own income.
Yeah, that's amazing. And so when you say a 1-to-1 ratio for the mortgage payment, are you talking principal, interest, taxes, and insurance as your mortgage payment, or truly just principal and interest?
Principal, interest, taxes, and insurance. So the way that it works, you wouldn't be buying a property that wouldn't make at the very least that each month, or
I
else
should
you wouldn't
hope
be
not.
buying
Yeah.
it because it's not a good investment. So I've never seen one not go through, unless you're buying in like a really weird remote area where no one has ever short-term or long-term rented before, then that would be probably a gray area. But in the big vacation markets and metro markets and things like that, I have never seen one not go through.
Awesome. What a cool product. That's great. And Avery, I'm curious to know from your experience, where do most new short-term investors go wrong? Where are you seeing them botch themselves?
Analysis paralysis, just like anything, just like any asset class, all real estate investing, the number one thing that stops people from getting started is analysis paralysis, and short-term is no different.
Oh, that's great. That's great. And so I'm just curious to know as well, you mentioned some of the markets that you're currently investing in, and you've got investors in both personal properties. Where is the new hot place?
So our newest market that we've opened an office in that I'm really excited about, probably the next place that I'm going to buy a short-term rental probably next year, is the Crystal Beach, Texas market. It's right next door to Galveston, and the returns there are actually higher than the Smokies, which up until now has been our highest return market. It's also one of the most expensive markets. In the Smokies, it's going to be $1 million for a 5-bedroom, maybe a little bit more. And to get a beachfront or like second tier back beach property, you can get a 5-bedroom, like a nice, pretty new 5-bedroom, new construction for like the 700 range.
Wow.
So, and make almost the same income as the Smokies. So don't quote me on that. It's a case by case basis, obviously, but across the board, the returns there are really, really exciting.
Oh, that's amazing. And when you say returns are high, what are we talking in terms of percentage cash on cash?
So it depends on what kind of loan you do, because obviously if you do a 10% down vacation home loan, your cash on cash is going to be twice the amount of what it would be if it's 20%.
Right.
But you're looking at 30% like without issue. So depending, and it depends on what kind of loan you get. But even with a 20% down, like you're looking at least 20% cash on cash. So really, really good.
Oh, that's amazing. That's amazing. So I'm curious to know too, and I don't want you to give away the secret sauce that's included in the book, but what are some things that people should be aware of with regard to professional management versus self-management?
So this is something that I talk about a lot. So, and this is not an across the board thing. I 100,000% have managers for my long terms. It's a different game. We're talking about short terms exclusively here. So if you are someone who is trying to use the income from short-term rentals to really bootstrap and boost that income and buy more properties faster, a traditional style property management company is probably not going to be the partner to help you get there. Managing one short-term rental is really only going to take you about 30 minutes per week. And it's not going to be all at once. It's going to be like, oh, I'm responding to a notification here. I'm responding to a notification there. It's really like answering a few text messages a week. You might have to pick up the phone and call a plumber sometimes, but it's really not anything. It's not any significant amount of work. I have 8. And so to give you some perspective, so the traditional property management split in short-term rental is average 25%. It was actually 40% when I started, but a lot of self-managers and stuff have kind of brought people have had to lower their rates to stay competitive. But even if I had a 25% manager this year, my properties are on track to hit an $800,000 gross this year. So if I paid somebody 20%, 25% of that, that's $200,000 this year. That's like upper management level salary to do something that I can do straight from my phone. Like, is it work? Yes, but it's very easy work considering the $200,000 that I would be paying someone else to do that for me. So when you look at it that way, it really makes a lot of sense. Once you get to probably about 10 properties, you might want to hire a virtual assistant to kind of help with things. But the way technology is now with channel managers and pricing managers, almost everything is automated. A lot of the things that were not automated when we started are now automated. So there's really no reason why, really anyone can't self-manage if they want to.
That's incredible. Nicely done. Nicely done. Avery, before I let you go here, I want to talk about your book, Short-Term Rental, Long-Term Wealth. What should people expect to find in it when they pick it up?
So you will find the first half of the book is about how to choose a market, how to analyze a property, how to find the team in that market to help you. So agent, mortgage broker, all those people. And then the second half of the book is actually about how to self-manage remotely so that you can keep that potentially $200,000 a year to get yourself started so that you can then grow your wealth through short-term rental investing.
Amazing. And people can pick that up on biggerpockets.com as well as amazon.com?
Yes. So right now it's on biggerpockets.com/STR book. You can pre-order it on Amazon. It will ship November 14th. It is also available on Audible right now as well.
Amazing. And if people want to take advantage of the short-term rental shop or the mortgage shop, what's the best way for them to get a hold of you and your companies?
So you want to go to theshorttermshop.com. There's a little box in the middle of the page that says schedule a consultation. Hit that button. That's the best way to get started with us. And then for the mortgage shop, you want to go to www.mortgageshop.co.
Amazing. Avery, this has been so much fun, so eye-opening. Any final thoughts for folks before I let you out of here?
I think we've pretty much covered it. Thank you so much for having me.
Awesome. Well, take care and we'll talk soon, I'm sure.
Thank you.
Alrighty, everybody. That was our episode. A big thank you to Avery. This was so much fun. I learned a ton. If you're interested in short-term rentals, I definitely recommend picking up Avery's book, as well as going back through this episode and giving it another listen. As always, thank you so much for listening, watching, and we look forward to seeing you on the next one. And happy investing.